Hey there, Iguana Nation. Iggy here, and today we're diving into the world of REITs. Specifically, we're going to be talking about Manulife US REITs, or MUST for short. Now, I know what you're thinking, Iggy, why should I care about some random REITs? Well, buckle up, because in this video, I'm going to show you why MUST might just be the turnaround play of 2024. We'll look at their recent performance, their strategies moving forward, and whether or not this high-yield REITs is worth your hard-earned cash. By the end of this video, you'll have a solid understanding of what's going on with MUST and whether or not it deserves a spot in your portfolio. So, grab a snack, sit back, and let's get started. A real estate investment trust, commonly known as a REITs, is a unique type of company that deals with income-generating real estate. This can encompass a wide range of property types, including shopping malls, apartments, offices, hotels, and warehouses. The primary business of a REITs is to own and manage these types of properties. When you make the decision to invest in a REITs, you're buying a piece of these properties. In other words, you're becoming a part owner of the real estate that the REITs owns and manages. This is similar to buying shares in a company where you become a part owner of that company. One of the most attractive aspects of investing in a REITs is the potential for income. Since REITs deal with income-generating properties, they generate revenue through the collection of rent. As an investor, you are entitled to a portion of this rental income. This is typically distributed to investors in the form of dividends, providing a regular income stream which can be particularly appealing to certain types of investors, such as retirees seeking a steady income. Now, let's talk about MUST. They recently released their business update for the first quarter of 2024, and there are a few key things to note. One of the most significant points is the change in their occupancy rate. At the end of 2023, MUST had an occupancy rate of 84.4%. This figure represents the percentage of their rental units or properties that were occupied or rented out. However, in the first quarter of 2024, this rate experienced a decline, falling to 78.7%. This drop of nearly 6% is a substantial one in the real estate industry and could potentially impact the company's revenue. The reason behind this decrease in occupancy rate can be traced back to one of MUST's major tenants, a company known as TCW. TCW decided not to renew their lease on a property named Figueroa. This decision by TCW has likely contributed to the drop in MUST's occupancy rate. The Figueroa property must have been a significant part of MUST's portfolio, and losing a tenant like TCW could have a noticeable impact. In the world of real estate, tenant renewals are crucial for maintaining a steady occupancy rate. When a large tenant like TCW chooses not to renew their lease, it can create a ripple effect on the company's performance. It's important for MUST to find a new tenant for the Figueroa property to recover from this setback and improve their occupancy rate in the upcoming quarters. Despite the challenges, there are still reasons to be optimistic about MUST's performance. During the recent quarter, MUST has been proactive in securing new leases, a positive sign for their business growth. One of their notable achievements includes securing a 13-year lease with The Children's Place, a well-known children's apparel retailer. This lease is for a property known as The Plaza, adding a reputable tenant to their portfolio. The total area covered by the new leases signed during this period is approximately 207,000 square feet. To put this into perspective, this represents about 4.1% of MUST's total portfolio. This is a significant addition, demonstrating MUST's ability to attract and secure tenants, thereby ensuring a steady revenue stream. Another key performance indicator in the real estate industry is the weighted average lease expiry, WALE. WALE provides an average measure of the length of time until all leases in a portfolio are set to expire. A longer WALE generally indicates more stable and secure rental income. As of March 31st, MUST's WALE stood at 4.3 years. This suggests that MUST has a relatively stable tenant base with leases that will provide consistent income for the next few years. Let's look into the financial aspects of MUST's performance. One of the key indicators we'll look at is the aggregate leverage. This is essentially a measure of how much of the company's assets are financed by debt. It's calculated as a ratio of the company's total debt to its total assets. A lower aggregate leverage ratio is generally seen as a positive sign as it indicates a reduction in debt levels relative to the company's assets. In the case of MUST, their aggregate leverage fell from 58.3% at the end of 2023 to 56.7% in the first quarter of 2024. This decrease in the debt-to-asset ratio indicates that MUST has been successful in reducing their overall debt levels. This is a positive sign as it suggests that the company is becoming less reliant on debt to finance its operations, which can lead to a healthier financial position in the long run. Another important financial metric to consider is the interest coverage ratio. This ratio measures a company's ability to meet its interest expenses on outstanding debt. It's calculated by dividing the company's earnings before interest and taxes, EBIT, by its interest expenses. A higher interest coverage ratio is generally better as it indicates that the company has sufficient earnings to cover its interest expenses multiple times over. For Must, their interest coverage ratio stands at 2.3 times. This means that their earnings are more than twice their interest expenses. This is a strong indicator of Must's financial health, as it suggests that they are generating enough income to comfortably cover the cost of their debt. In other words, for every dollar they owe in interest, they earn $2.30, providing a comfortable buffer. As we look towards the future, Must has outlined several key priorities that will guide their strategic decisions. One of these priorities is to focus on the sale of some of their assets. This is a common strategy used by real estate companies to generate cash, which can then be used to fund new investments or reduce debt. By selling assets that are non-core or underperforming, Must can ensure they are focusing their resources on the areas of their portfolio that offer the best returns. Another priority for Must is to manage their capital expenditure effectively. Capital expenditure, often referred to as CapEx, is the money that a company spends on maintaining and improving their properties. This could include anything from routine maintenance to major renovations or even the construction of new buildings. By keeping their CapEx in check, Must can ensure they are not overspending on their properties while still maintaining the quality and attractiveness of their portfolio to potential tenants. Finally, Must is also looking to optimize their leasing and asset management strategies. This involves making sure they are getting the most out of their properties, both in terms of rental income and the appreciation of the property's value. This could involve strategies such as negotiating favorable lease terms, investing in improvements to increase a property's value, or even repositioning a property to attract a different type of tenant. In the long run, Must has a strategic plan to reposition their portfolio. This involves diversifying their investments into assets that not only offer higher returns but also require less capital investment. This strategy is aimed at enhancing the profitability of their portfolio while reducing the financial burden associated with maintaining and improving their properties. In addition, Must is also focused on optimizing their portfolio to support long-term, risk-adjusted cash flows. This means they are aiming to balance their investments in a way that maximizes returns while minimizing risk. This strategy is designed to ensure a steady stream of income over the long term, which can be distributed to their investors. So, what does this mean for you as a potential investor? Investing in real estate investment trusts, REITs, like Must, or any investment for that matter, comes with its own set of risks. The real estate market can be volatile and unpredictable. There's always the risk of tenants not renewing their leases or defaulting on their rent payments, which could impact the income generated by the property. However, investing in REITs also comes with several benefits. One of the main advantages is the potential for regular income distributions. REITs are required to distribute a significant portion of their income to their investors, which can provide a steady stream of income. Additionally, there's also the potential for long-term capital appreciation as the value of the properties in the REIT's portfolio increases over time. If you're considering investing in Must or any other REITs, it's important to do your due diligence. This involves understanding the company's business model, their investment strategy, and the potential risks and rewards. It's also a good idea to consult with a financial advisor or do your own research to ensure that the investment aligns with your financial goals and risk tolerance. In conclusion, while investing in REITs like Must comes with certain risks, it also offers the potential for regular income distributions and long-term capital appreciation. By focusing on repositioning their portfolio and optimizing their investments, Must is working towards providing sustainable, risk-adjusted returns for their investors. As with any investment, understanding the risks and rewards is key to making informed decisions. All right, Iguana Nation, that's a wrap on our deep dive into Manulife US REITs. We covered a lot of ground today, from their recent occupancy rates and leasing activities to their financial metrics and future strategies. As always, it's important to remember that investing in REITs, or any investment for that matter, comes with risks. But if you're looking for a high-yield play with some potential upside, Must might just be worth a closer look. Of course, don't just take my word for it. Always do your own research and make sure any investment aligns with your personal goals and risk tolerance. If you found this video helpful, be sure to smash that like button and subscribe to the channel for more insights and analysis from yours truly. And if you have any questions or topics you'd like me to cover in future videos, leave a comment below. Until next time, Iguana Nation, stay curious, stay informed, and happy investing.